IFRS 17. What is an insurance contract? The policy holder is compensated by the insurance company for the medical cost. IFRS 17 become effective for period commencing on or after 1st January 2023. IFRS 17 simplifies the profit and loss presentation. IFRS 17 insurance contract is known as one of the most complex accounting standard because it deals with future and a lot of uncertainties. Let me simplify it for you. My name is Murtaza Quaid, representing the IQ School of Finance. IFRS 17 become effective for period commencing on or after 1st January 2023. This means that IFRS 4 is not used anymore. Let's explore the specific provision of IFRS 17 covering a few key topics. First of all, let's start with an introduction to IFRS 17. This standard set out the goal, explain the main terms, and talks about the aggregation and separating component in the contract. Next, IFRS 17 covers when to start accounting for an insurance contract in the accounts. That's about the recognition. Then we have rules for measurement or the amount that should be recognized with respect to the insurance contract, both initially when the contract first starts and subsequently in the subsequent reporting period. IFRS 17 guides us in two major approaches, general approach and premium allocation approach. But of course, we have also variable fee approach and modified general approach and others. Next, IFRS 17 talks about modification and de-recognition of insurance contract. And finally, IFRS 17 covers how insurance contracts are presented and disclosed in the financial statement. So that's a quick look at what is included in IFRS 17. Now let's see to which type of contract we need to apply IFRS 17. It is for all insurance contract issued, including reinsurance contract issued and also for reinsurance contract held. Think of reinsurance as insurance for insurance itself. IFRS 17 is also applied for investment contract with discretionary participation features if the company also issues insurance contract. It is important to remember that IFRS 17 is not just for insurance companies, it is for any insurance contract. Additionally, the standard outlines certain items that don't fall under its scope, which you can view them on the screen. So always check the standard for similar items. And as you can see, there are items that can potentially meet the definition of insurance contract but are actually excluded, such as product warranties issued by the manufacturer, dealer or retailer. Also, let me point out that IFRS 17 does not apply to insurance contract held. If you purchase an insurance policy, pay the insurance fee or insurance premium and gets the insurance coverage, IFRS 17 does not apply to these. Now let's understand what is an insurance contract. According to the official definition, it is a contract under which one party, that is insurer, accepts significant insurance risk from another party, that is policyholder, by agreeing to compensate the policyholder if a specific uncertain future event or insured event adversely affect the policyholder. For example, consider the significant insurance risk to be a health emergency and a person buy a health insurance policy to cover the medical expenses. If that person then faces a serious health issue requiring expensive treatment, the policy holder is compensated by the insurance company for the medical cost. This scenario underscores that insurance is about managing the risk of uncertain future event rather than predicting event with certainty. IFRS 17 provides detailed guidance on various aspects of the definition of insurance contract, such as what constitutes insurance risk and so on. It is common for insurance contract to include additional elements beyond the core insurance coverage. These extra elements could be an embedded derivative, an investment component, or distinct goods or services. The crucial point here is that if any of these three components are part of an insurance contract, the entity must separate those components from the main insurance contract. Separate essentially means that the separated component will be accounted for under a different accounting standard and not under IFRS 17. This requires us to exclude the cash flows associated with that component from the contract, and the remaining contract will be accounted for under IFRS 17. The specific standard applied to the non-insurance component depends on what component it is. Typically, you would apply either IFRS 9 for financial instrument or IFRS 15 for revenue from contract with customers. Now let's delve into the grouping and aggregation. An insurer must define the level of aggregation of the insurance contract or how to group the insurance contract. Why is this important? It is because the insurer need to evaluate the insurance contract and their profitability at portfolio level and on the basis of group of contract and not on the basis of individual contract. This process can be broken down into three steps. The first step occurs upon initial recognition, where the insurer assigns an insurance contract to a specific portfolio of contract. A portfolio is essentially a larger grouping of contracts that share similar risk and are managed together. For example, this could include different product lines such as portfolio for vehicle insurance contract, property insurance contract, or life insurance contract. Following that, the step 2 involves dividing the portfolio into at least 3 groups as mandated by the minimum requirement of IFRS 17. These groups are organized as follows. Group 1 consists of contracts that are onerous or loss-making at inception. Group 2 includes contracts that have no significant possibility of becoming onerous subsequent to their initial recognition. And Group 3 encompasses all the remaining contracts. In the third step, it is necessary to form separate groups within the same portfolio at least annually, ensuring that the amount within the same group are no more than 1 year apart in terms of their inception date. This organization allows for a more detailed and accurate assessment of the contract's profitability and risk over time. This concept is fully illustrated in our complete IFRS 17 course, so you might want to check out for a deeper understanding. Now let's discuss the initial recognition of insurance contract. A group of insurance contracts should be recognized on the earliest of the 3 dates possible. First, the start of the coverage period, which is essentially the period during which the insurer is providing the insurance services. Next, it could be the date when the policyholder's payment is due, and if the contract does not specify such a date, it is when the first payment is actually received. And finally, for the group of onerous contract, it is the date when that group becomes the onerous or the loss-making. It is important to remember that our discussion is about group of contract and not individual contract because IFRS 17 focuses on groups. However, it is worth mentioning that the assessment for initial recognition is made individually for each contract within the group. Now let's discuss how to measure the group of insurance contract. When measuring group of insurance contract, there are several models to choose from, and the primary model is general measurement model. This model is applicable to all insurance contracts except for few exceptions that we will discuss. This model does not differentiate between the individual types and the duration of contract or between the short-term, long-term, life or non-life insurance. It applies uniformly to all insurance contracts. The core principle of the general model is how it deals with the onerous insurance contract, which are those that are loss-making or anticipated to generate loss right from their inception. IFRS 17 mandates the immediate recognition of a loss for such contract in the profit and loss at the time of initial recognition. On the other hand, for insurance contracts that are profit-making or at least not loss-making, IFRS 17 does not allow for the immediate recognition of profit. Instead, such contract must initially be recognized at zero profit, and any profit that arises over time as the contract performs is recognized gradually. This deferred profit is referred to as contractual service margin. IFRS 17 also introduces some modification to the general model. First, there is simplified model known as premium allocation approach, which can be used for insurance contract meeting certain criteria. IFRS 17 also offers additional methods. For group of reinsurance contract held, the general model may be used with some modification, or the premium allocation approach can be adapted as well. For insurance contract with direct participation feature, the variable fee approach is recommended. Meanwhile, investment contract with discretionary participation feature should also follow the general model even with certain modifications. This gives you a brief outline of the different methods for measuring insurance contract under IFRS 17. Now let's turn our attention to the fundamental components of the general model. The key question is what will appear on the statement of financial position in relation to the group of insurance contract. You will see a single figure representing either an insurance contract liability or in some cases an asset. That liability at any point in time is the aggregate of two components. Number one, the liability for remaining coverage, and number two, the liability for incurred claims. Now the liability for remaining coverage itself breaks down into two parts. The first part is the fulfillment cash flows related to future services, which includes all cash inflows and cash outflows associated with the group of contract. And the second part is the contractual service margin, representing the profit the insurer expects to earn from this group of contract throughout their coverage period. Let me explain here that the liability for the remaining coverage relates to the future services. This means that the insurer needs to make a lot of estimates because the future is not known. On the other hand, liability for incurred claims relate to past services. This area is somewhat clearer for insurer since it is based on events that have already occurred, and the insurer typically knows which insurance event happened and how much it would have to reimburse to the policyholder. To make this easier to understand, let's take a look at a simple timeline. Imagine there is an insurance contract that started on 1st January year 1 and will end on 31st December year 5, lasting 5 years. Now let's say we are preparing the financial statement as of 31st December year 2. This marks the end of the reporting period in our example. In this scenario, the period from the start of the contract until the reporting date is considered the past for which we have the data. Therefore, we will measure the liability for the incurred claims as a component in the measurement of our contract for this past period. And the second period, which runs from the end of the reporting date, that is 31st December year 2, until the contract conclusion in year 5, represents the future. Since we do not know exactly what claims will occur during this time, we can only make the estimates. This period is where our liability for the remaining coverage period comes into play, as it covers potential future claims. And that's the very simple overview of general model. Now let's take a closer look to the liability for the remaining coverage, because this is where the expertise of the actuaries is crucial. This liability is measured as the total of fulfillment cash flows and the contractual service margin. The fulfillment cash flows comprises estimate of future cash flows, which are essentially projected cash inflows from the group of insurance contract. These inflows are positive aspect because they mainly represent the insurance premium received from the policyholders. On the flip side, there are estimated future cash outflows from the group of insurance contract. These outflows are considered a negative because cash is being spent. Here we are looking at expenses such as payment for insurance claim, servicing cost and similar items. Considering these cash flows occur in the future, it is important to account for the time value of the money. This means we need to discount those cash flows to their present value. Additionally, these cash flows need to be adjusted for non-financial risk, which is where the risk adjustments come into play, and it is typically accounted for as a deduction. The balance between these inflows and outflows is what forms the contractual service margin. Essentially, this margin represents the unearned profit from the group of insurance contract at the initial recognition. It is calculated as the negative value of the net fulfillment cash flows, meaning the total should net to zero for the contract that are considered profitable. This process ensures that the financial position initially reflects no profit for this contract, in line with IFRS 17 principle of recognizing profit over the coverage period as the services is provided. In our comprehensive IFRS 17 course, we will delve deep into these concepts using many practical examples and Excel exercises. If you are looking to significantly enhance your understanding of IFRS 17, make sure to check it out. Alright, so far we have discussed the general model, which is applicable to all insurance contracts with a few exceptions. Next up, we have a simplified model, that is premium allocation approach. You can only use the simplified approach or the premium allocation approach for certain group of insurance contract that meets specific criteria. This includes scenarios where the liability for remaining coverage under this simplified approach does not significantly differ from what it would be under the general model. To determine this, you need to perform a comparison test. Alternatively, this approach can be applied if the coverage period for all the contract within the group is 1 year or less. Indeed, opting for simplified model is a choice, not a mandatory. However, it is often advantageous to apply it because it simplifies the accounting process compared to the general model. Let's clarify a bit. Under the general model, you calculate the insurance contract liability by adding the liability for remaining coverage, which refers to the future, and the liability for the incurred claims. We have already learned about these components. Under the premium allocation approach, the process looks quite similar. You still calculate the insurance contract liability by combining the liability for remaining coverage and the liability for incurred claims. However, the key difference is that the liability for remaining coverage is calculated simply based on the unearned premium, adjusted for few items without the detailed building blocks. This simplicity is what sets it apart, while the liability for the incurred claims remains the same as under the general model. For those interested in a specific numerical example of the premium allocation approach, our complete IFRS 17 course covers it in detail. Moving to the presentation, let's discuss how amount should be shown in the statement of financial position. You will see insurance contract asset and reinsurance contract asset listed separately, as well as insurance contract liabilities and reinsurance contract liabilities also separately. Unlike the previous standard IFRS 4, asset and liabilities are not offset under IFRS 17, simplifying the presentation. In the statement of profit and loss, you must present insurance revenue, essentially premiums with some adjustment, and the insurance service expense such as claims and changes in fulfillment cash flows. The difference between the insurance service revenue and the service expense gives you the insurance service result. Then you address the insurance finance income and expenses, including the effect of changes in the time value of money. IFRS 17 simplifies the profit and loss presentation with just a few line items and requires extensive disclosure. This summary just scratches the surface of IFRS 17. If you are eager to dive deeper with numerical examples and step-by-step solution, I encourage you to explore our complete IFRS 17 course featuring full video content on the standard. Thank you for watching and don't forget to follow and share this video if you found it helpful. Goodbye for now.